Thank you so much, Grace. Welcome to UK Prime Time, everybody. Once again, today we are going to start episode 22 of Rift Before You Quit, and we are going to enter into the prop trading revolution. How capital will be allocated by intelligence, reputation, and performance. Every great civilization has faced the same question: who should be trusted with capital? Banks ask it, investment firms ask it, venture capitalists ask it, governments ask it, even families ask it. Because throughout history, wealth has never simply flowed to those who needed capital. It has flowed to those who demonstrated they could manage it. For centuries, access to institutional capital was reserved for a very small group of professionals. If you wanted to trade millions of dollars, you didn't simply open an online account. You need you needed experience, education, performance, discipline, and most importantly, someone who is willing to trust with you with their money. The system eventually evolved into what financial world calls proprietary trading or simply prop trading. Today, prop trading has become one of the fastest growing sectors of global financial markets. Thousands of firms now provide traders with access to capital that would have unimaginable just 20 years ago. But behind the marketing campaigns, the funded account challenges, and the social media success stories lies a sophisticated industry built on institutional risk management, capital allocation, and statistical probability. Prop trading isn't about finding lucky traders, it's about finding repeatable decision makers. And as artificial intelligence, analytics, and financial infrastructure continues to evolve, the next generation of prop trading may look very different from today's evaluation models. In this episode, we'll explore where proprietary trading began, how institutions truly evaluate talent, why most funded traders fail, and how the future of capital allocation may become driven by intelligence, consistency, and infrastructure rather than one time trading challenges. Evolution of capital allocation. Personal savings, brokerage accounts, investment banks, institutional prop desks, retail prop firms, AI-assisted capital allocation, and autonomous financial infrastructure. In every explanation, every discussion, we are aiming towards not just building but achieving autonomous financial infrastructure. If you may all have noticed in my explanations, figures, charts, we are heading towards autonomous financial infrastructure, which is capital managed infrastructure that is fully autonomous, not just uh, human driven, not just totally AI driven, but it's a mixture of human plus AI financial infrastructure that is capitally intelligent. So, capital allocation has evolved from individual investment decisions to increasingly intelligent and data driven evaluation systems. Why prop trading exists? Imagine walking into a bank and asking for 10 million to trade in financial markets. Bank's first question would not be, which stock are you going to buy? Instead, it would ask, why should we trust you with our capital? That question lies at the heart of prop trading. Prop trading exists because financial institutions recognize a simple reality. Not everyone possesses the same ability to manage risk. Some individuals consistently protect capital. Others consistently destroy it. Professional institutions don't simply search for profitable traders, they search for disciplined capital managers. Why? What is prop trading? Prop trading occurs when a financial institution provides its own capital to traders with the objective of generating returns or profits. Unlike traditional brokerage firms, which earn commissions by facilitating customer trades, prop firms deploy their own funds and share profits with successful traders. This distinction is important. A broker earns money whether clients win or lose. It is not a prop firm is not a brokerage firm. A proprietary trading firm succeeds only when capital is managed effectively over time. This creates fundamentally different relationship between the trader and the institution. The trader contributes skill, the firm contributes capital. Both share the outcome. Broker versus prop firm. Brokerage firm or broking institution is simply client's capital, broker's platform, and there is commission revenue generated from the platform. But a prop firm is really different and distinct, where there is firm's capital and there are professional traders which share profit with the firm. Why don't institutions just trade themselves? Of course, it's a very common and very obvious and very generic question. Large financial institutions certainly employ professional traders. However, global markets generate far more opportunities than any single internal team can pursue. Different traders specialize in different areas: forex, equity, commodities, futures, options, crypto, quant strategies, high frequency trading, macro investing. Expanding access to skilled external traders allows firms to diversify strategies, explore new opportunities, and scale capital deployment while maintaining centralized risk management. In essence, proprietary trading is a way to combine external talent with institutional capital. If we look at the market, many of the world's leading quant and proprietary trading firms, including organizations such as Jane Street, DRV, Jump Trading, and Optiveer, operate by combining advanced technology, rigorous risk management, and highly specialized trading teams. While their business models differ, they illustrate how institutions invest heavily in talent, systems, and disciplined execution rather than relying on individual intuition alone. The prop trading relationship. Institution, capital, trader, execution, risk monitoring, performance, and profit sharing. So this is the chain which leads to profit sharing comes along uh, the bridge, which is skill or talent. The relationship between protectorate relationship between a skilled trader and a prop firm is these, you know, layers, which is first and foremost the most important thing, that is capital, skilled trader, execution, risk monitoring, performance, and ultimately they both are achieving profit sharing goal. History of prop trading. Proprietary trading did not begin with online funding challenges. It roots back to several decades. During 1980s and 1990s, major investment banks maintained dedicated prop trading desks. These desks traded the bank's own capital across equities, bonds, currencies, commodities, and derivatives. The objective was simple: generate returns beyond traditional banking services. Some desks managed billions of dollars and employed teams of economists, mathematicians, programmers, statisticians, and experienced traders. As electronic markets emerged in late 1990s and early 2000s, trading became faster, more data-driven, and increasingly quantitative. Algorithms began executing trades in milliseconds. Risk models became more sophisticated. Artificial intelligence and machine learning gradually entered institutional workflows. The financial crisis of 2008 then reshaped the industry. And if you all remember when we were talking about Bitcoin, when we were, I don't know if you guys have been through the other series that I took with Vietnamese um community. I think you all have been through that series also. What was the name? The Future of Finance, right?
Beyond Human Finance.
Beyond Human Finance. So, in Beyond Human Finance, we talked about the reason why Bitcoin came into existence, why we needed decentralized finance, and why it was a necessity rather than a technology innovation, because banks collapsed in 2008. Bitcoin was not something that came as an invention, it was a necessity, and it emerged as a necessity, and whole decentralized finance emerged as a necessity. Similarly, the financial crisis of 2008 reshaped the trading industry as well. Following the crisis, regulations such as Volcker rule in the US restricted many forms of prop trading within commercial banks. As a result, much of the industry's talent migrated towards independent hedge funds, quant firms, and specialized prop trading companies. This shift accelerated innovation and eventually contributed to the rise of modern retail focused prop firms. Evolution of prop trading. Initially, it used to be in desks, then it came into electronic markets, then in quant trading, then it faced 2008, it faced with the banks collapsing, it faced challenges. By 2015, we saw many independent prop firms coming into the existence, and by 2020, we started looking at remote funding models where there were prop challenges and users, traders, skilled people used to receive capital from the companies, firms directly. And the future is AI-driven capital allocation, where we are heading as an industry, not just our ecosystem, but as an industry, we are heading towards AI-driven capital allocation. The prop trading industry today. Today's prop trading industry is remarkably diverse. At one end of the spectrum are institutional firms managing billions of dollars through sophisticated quantitative and discretionary strategies. And at the other end are retail oriented evaluation firms that allow individuals to demonstrate trading ability through structured assessment programs. We are also using one of these firms. These models differ significantly, but they share a common objective: identify traders capable of managing risks responsibly. The rapid growth of digital trading platforms, cloud infrastructure, and global connectivity has transformed prop trading into a worldwide industry. Talented participants can now engage with evaluation programs and trading environments from virtually everywhere with a reliable internet connection. This democratization has expanded access to opportunity, but it has also increased competition. Standing out now requires more than technical analysis or market prediction. It requires consistency, discipline, and repeatable decision making. Industry reports estimate that prop trading sector has expanded rapidly in recent years, driven by advances in electronic trading, lower technology barriers, and growing interest in remote participation models. At the same time, institutional firms continue to invest heavily in quant research, AI-assisted analytics, and increasingly sophisticated risk management frameworks. Modern prop trading infrastructure ecosystem. Institutional prop firms, quant firms, hedge funds, retail evaluation firms, independent traders, and wholesome it churns out, or it basically uh, differentiates global digital uh, talent and sets it apart from the retail traders or institutional traders. This is separately a different world of people striving to get some funds to share profit with the institutions directly. Because getting access to institutional capital is something which is, I would say, impossible. If you're skilled and if you're consistent, then only you have that access and you have that continued access. Getting access is not difficult. And today I'm telling you all, many of you who will participate in prop challenges, you all may pass once, you all may get funding once, but consistently remaining funded will be hell of a task. So, that is the bigger challenge when it comes to industry from the firm's perspective as a institution, as well as from the trader's perspective as a end user as well. Prop trading was never just about placing trades. It was all about answering one question. Who deserves access to capital? Over time, that question has become increasingly sophisticated. Institutions have moved beyond evaluating profits alone. They now examine discipline, consistency, risk management, execution quality, and long-term performance. And as technology advances, these evaluation models continue to evolve. But before we explore how AI and dynamic capital scoring may shape the future, we must first understand how today's prop firms actually operate and why so many funded traders lose access to capital despite passing their initial evaluations. Because receiving funding is only the beginning. Managing institutional capital is an entirely different challenge. We learned that prop trading was never simply about giving traders larger accounts. It was created to solve one fundamental problem. How can institutions identify people capable of managing capital responsibly? But this leads to another question. If prop firms provide millions of dollars in buying power, how do they stay profitable? And perhaps an even bigger question, why do nearly 80 to 95% of funded traders eventually lose their funded accounts? If someone is skilled enough to pass an evaluation, why do they fail after receiving capital? The answer has very little to do with technical analysis and almost everything to do with psychology, risk management, and human behavior. Today, we'll go behind the scenes of prop trading industry to understand how prop firms actually operate, why most traders fail, and what institutions really look for when allocating capital. The life cycle of a funded trader. Trader learns, passes evaluation, receives capital, faces psychological pressure, either builds consistency and increases or gets capital growth, or breaks risk rules and accounts. They get blown away and they lose the funded accounts. Receiving funding is only the beginning. Sustaining performance is the true challenge. How prop firms really make money. One of the biggest misconceptions about prop trading firm is that they earn money when traders are profitable. Reality is far more complex. Prop firms operate as risk businesses, not gambling businesses. Their objective is not to predict markets, their objective is to identify repeatable traders while protecting institutional capital. Most firms generate revenue through multiple channels operating simultaneously. The first and the foremost and the biggest is evaluation programs. The fee that prop firm collects to evaluate the traders, the mass segregation, where the masses are separated initially in the screening phase from the skilled traders who can potentially pass the challenge. These assessments are designed to measure discipline, consistency, and rule adherence before allocating larger pools of capital. The evaluation process also helps filter participants who are unlikely to manage institutional risk effectively. Second is profit sharing. Once traders become funded, profits are typically shared between the trader and the firm according to predefined agreements. This aligns incentives between both parties. The better the trader performs over time, the stronger the relationship becomes. Risk diversification. No institution relies on a single trader. Professional firms allocate capital across many individuals, strategies, markets, and time horizons. Losses from one strategy may be offset by gains from another. Diversification remains one of the oldest principles in institutional finance. Then capital scaling. Successful traders rarely remain on the same account size. Institutions gradually increase allocations as confidence grows through measurable performance. Capital is earned, not granted permanently. So how prop firms operate? Applications, evaluation, then risk filters, then the traders who are funded, they are under performance monitoring, and their capital scaling is done consistently. And then there is profit sharing, which is regular day on day profit sharing as the trades close. Why most funded traders fail. Passing an evaluation and managing capital are completely different experiences. Evaluations measure whether a trader can follow rules. Live funding tests whether a trader will continue following them. Once real capital is involved, psychology changes dramatically. Common reasons why funded traders fail because over leverage. Believing larger positions create faster success. In reality, excessive leverage often accelerates losses. Revenge trading, attempting to recover losses immediately after a losing trade. Instead of following a structured plan, traders begin reacting emotionally. Rule violations, ignoring daily stop loss limits, increasing position size without justification, removing stop loss orders, holding positions beyond predefined risk parameters. These behaviors often end funded accounts, not poor market analysis. Overconfidence. Several profitable trades can create the illusion of invincibility. Discipline gradually disappears, risk expands. Eventually, one oversized mistake erases weeks or months of steady progress. Decision fatigue. Professional trading requires thousands of decisions. As mental energy declines, judgment often deteriorates. Even experienced traders become vulnerable to impulsive actions. Many established proprietary firms report that breaches of risk rules rather than lack of market knowledge are among most common reasons funded traders lose access to allocated capital. Consistency and discipline typically outweigh occasional high returns. Why funded traders? Emotion, overconfidence, rule violations, large drawdowns, loss of capital, and then it leads to termination of the prop account. The neuroscience of funded trading. Trading is not only financial activity, it's a neurological one. Every position activates powerful chemical responses inside the brain. Understanding these reactions helps explain why disciplined traders often outperform emotional ones. The most important of all is cortisol, the stress hormone. When a trade moves against a position, cortisol's level increase. This can narrow attention, reduce analytical thinking, and encourage defensive decisions. And that's how people uh, they close positions too early. They ignore trading plans. They avoid valid opportunities after losses. Then dopamine, the reward chemical. Winning trades trigger dopamine release. While rewarding, repeated success can create overconfidence and encourage unnecessary risk taking. The pursuit of another emotional high may lead traders away from disciplined execution. Then amyl amygdala activation. This is a very good concept that Grace is going to read today. The amygdala is responsible for detecting threats. In financial markets, temporary losses can be interpreted by the brain as immediate danger. Whenever you touch something hot, kind of concept. This often leads to panic selling or abandoning long-term strategies. Then prefrontal cortex. The prefrontal cortex supports planning, logical reasoning, and impulse control. Your brain functions, like that. Professional traders seek to operate from this part of the brain rather than reacting emotionally through fear or excitement. The goal is not to eliminate emotion. The goal is to prevent emotion from controlling execution, the trader's brain. On winning trade, there is dopamine, there is confidence, there is potential overconfidence. On a losing trade, there is high cortisol stress and there is impulsive emotional decision making of taking another position, retaining the existing one, dipping it more in loss, all sort of things. So it's a neurological activity, not just statistical, financial, or scientific or uh, technical, or just commercial activity. Drawdown is the real enemy. Most traders believe they are competing against the market. Professional firms understand the real opponent is uncontrolled drawdown. A drawdown is a decline of from a portfolio's peak value before a new high is achieved. Every institution accepts that losses are inevitable. What they cannot accept is uncontrolled loss. Consider two traders. Trader A earns 25, loses 22, earns 18, loses 15. Performance is inconsistent, capital experiences significant fluctuations. Overall, result is a loss. Trader B makes 3, makes 2, loses 1, makes 4, and makes 2. Returns appear modest, but the equity curve is stable. Institutions overwhelmingly prefer Trader B because stable performance is easier to scale than volatile performance. The mathematics of recovery. A loss of 10% can be recovered by 11.1% profit. 20% loss can be recovered by 25% profit. 30%, 42, and we have discussed this many times previously in last 21 episodes. I believe 4 or 5 times how big losses can be whenever it is required, whenever it comes to, you know, bringing back to even. The larger the drawdown, the harder recovery becomes, and it becomes difficult to recover when it is a 50% loss or a drawdown. It is almost double that you have to make in order to just come at break even. The drawdown spiral. Whenever there's a loss, there is emotional response, and whenever you have emotional response over a loss, there are the positions automatically. Your brain's activity spread the positions into a little larger size so that your brain actually thinks of bringing another 100% profit to recover 50% loss, and that digs you into the bigger ditch of bigger loss. Then there are when there are bigger losses, then there are rule violations, and as soon as the rules are violated, the accounts they get confiscated, and the funded accounts they get uh, forfeited immediately. Proprietary trading is often marketed as pathway to larger capital. In reality, it is a continuous test of discipline. The market does not reward intelligence alone. Institutions do not fund confidence alone. Long-term success comes from combining emotional control, structured risk management, consistent execution, capital preservation. These are the qualities that separate traders from professional capital managers. But understanding psychology is only the beginning. The next question is even more important. How do hedge funds, quant firms, and institutional investors actually measure trading skill? Because the world's largest investment organizations rarely evaluate traders by win rate alone. Instead, they rely on sophisticated mathematical frameworks that measure risk, consistency, and capital efficiency. Why most funded traders lose their accounts? Not because they couldn't analyze the markets, but because they couldn't consistently manage risk. Now we arrive at an even bigger revelation. Professional institutions don't evaluate traders the same way retail traders evaluate themselves. Retail traders ask, how much money did I make? Professional firms ask, how much risk did you take to make that kind of money? The single question separates gambling from professional investing. Because anyone can make money once. Institutions pay for people who can do it repeatedly. Today, we are going to, not today, but on Wednesday, we are going to step into the world of hedge funds, quant firms, family offices, and institutional asset managers to understand how prop professional capital is actually evaluated. So, retail thinking versus institutional thinking. We are going to start from Wednesday. Why winded means almost nothing. So from Wednesday, we will start from page 45, Grace.